Welcome to the All Financial Hour podcast with Steve All.
Now is a really good time to start making sure that you're on track for maybe end-of-year planning or maybe preparing for a better 2025. And, there's this little thing called an election less than a month away. Are you prepared and protected despite whatever direction it goes? Are you prepared if there's some backlash? And, Steve, I know you and the team, you guys have been hearing a lot about this election talk.
Yeah, the big thing about the election, it's always fun because I have clients from both sides of the aisle. So I always get asked, what's going to happen with the election? And I look at it and I said, for me this year, I look at it to the fact that we won't know who the president is that Tuesday evening at 10 o'clock, like when Walter Cronkite would come on the news when we were younger and say the new president is X, Y, or Z. So we're not going to know that. It's going to be delayed past that. And then the other thing that I will state around that time frame, 50% of the population is going to be delighted and about 50% of the population is going to be angry. Mm-hmm. And I always say that I usually get calls after an election. I know two calls that I'm going to get the day after the election. One, I believe that the market is going to tank. Please take me out of the market. It's my job to talk to them about some sense. What do? Elections don't do this. And on that exact same day, the one that I got the person that's saying, pull it out because everything's going to crash. Two, how can I get more aggressive because I think everything's going to be wonderful. Two people, same election, completely different mindsets the day after the election. So I have to remind both that in most cases, the volatility is before the election. After the election, we might have a little, but then it kind of calms down. And that's the thing that I don't think most people believe. Most people believe because of all the fear and crisis that goes on in social media and then some of the news today from both sides of the aisle. Please, I'm not picking on one or the other. Both sides of the aisle. It's chaos is what they're scaring people around. In most cases, after the election, it takes a short amount of time, and there's really not a big difference if we look at the 4-year periods of a Republican or 4-year periods of a Democrat. Over time, there's not that big of a difference depending on which party is actually in the Oval Office. As I usually state in all my presentations is I don't think either side of the aisle has done a very good job of the money that I send them on taxes.
I agree.
They both spend too much. They just spend it on different things. So
Yeah.
the idea around it of it is that we have to, I think that's one of the advantages of me as a financial advisor. Because that same day, like I said, one says chaos, one says euphoric. Both might want to back down a little bit. Let's bring it back down to reality. Let's look at that long-term plan that we have for our investments and stay focused on that, because those emotional decisions are usually what cause people the most problems when it comes to elections. So just be careful with that on the elections.
Apparently, this is a huge debate, Steve, so I need you to weigh in on this. Calculating how much to withdraw from a retirement portfolio. Okay, so should it be 2%? The industry recommended 4%, or should it be more? Well, Manisha Thakur is author of the book Money's In, The Secret of Finding Your Enough. She tells Morningstar there's other things that you need to consider.
The order of returns when you retire make a huge difference. If you retire into a bull market, you're in great shape. If you retire into a bear market and you're pulling out money when assets are depressed, it can really shake up the statistical odds of not outliving your money. And so I encourage people to be really strategic about how they're going to access the money they need for the first 5 years. And if you're conservative like me, the first 10 years, so that you do not have to sell depressed assets in order to execute your retirement plan.
Okay, interesting. So, Steve, when you map out a retirement plan, how far ahead do you actually look when you start calculating withdrawals?
Well, when we look at it, and I will agree that sequence of return is very important. I think having some of that money for the first 1 or 2 years can be very important. But when people start to look at it and they look at those numbers, those percentages, 2% or 4%, it's really hard for people when they look at a portfolio to say 2 to 4%. That means if you have $1 million, you can take 20 grand out to spend. And most people say, well, if I got $1 million, I had to be able to spend a lot more than that. So that's the thing that we look at. And I think the biggest question that we get asked is, how am I going to replace my paycheck when I get retired? because you're going to have the old three-legged stool, Social Security, pension, and your personal savings. So we want to look at this and say, okay, how much is your guaranteed incomes, Social Security and pensions versus your lifestyle? Because now we're talking about where do we get the money from? That's what she was talking about. So we look at it at a point and say, how could you do that if you had a $1,500 gap between your guaranteed incomes and your lifestyle? We could look at it and say, hey, I can give money to an annuity company and turn on an income stream that's guaranteed for the rest of my life. That could cover my, quote, lifestyle expenses. Now, I have to give that money to an insurance company. So we'll go from that. Guaranteed by the insurance company. Then we could do what she said, 4%, 2%, 3%. Do a percentage of assets. Or we could have a portfolio built with bonds, preferred stocks, or dividend-paying stocks. Those are usually going to pay in that 3 to 5% range. So that gives us that fixed income that we're looking for. So if you're asking yourself how you're going to replace your paycheck in retirement, call now. Ask for the income plan. We're going to look at where you're currently at, what that gap is, and what are different ways that you can cover it. Because that is the question that most people ask. How am I going to replace my paycheck when I quit working?
Some big news in the Social Security world. The cost of living adjustment is in. Turns out beneficiaries will receive 2.5% more in 2025. But believe it or not, that's not as much as previous increases. This year, they got a 3.2% increase. Back in 2023, it was actually 8.7%. Cooling inflation is responsible for the lowering hike there, but tell that to seniors who are struggling to pay for basic needs. And Steve, I know you have an answer here. There's got to be something we can do now so that we can avoid all the stress moving forward.
Yeah, for those that are currently there, the seniors that are struggling now, there's not a whole lot that can be done. If you've already turned on your Social Security, there's not a whole lot can be done in the Social Security world. One of the things that they are talking about in Congress is increasing the minimum amount of Social Security to assist those that's all they're living on. But we have to remember that Social Security, a lot of people don't know what the OASDI stands for when they start talking about Social Security. It's Old Age Survivors Disability Income. Social Security was designed for people that were outliving life expectancy so that they could have an income during retirement. It was not designed as a retirement plan. And then we look back, we used to have a three-legged stool. That three-legged stool says we have Social Security income, we have a pension, and we have our personal savings. Well, let's look at that. Not as many places have pensions today. So the pension's kind of gone away. So for most people, we have a two-legged stool, Social Security and our personal savings. So if I don't build that personal savings, I'm trying to retire on one leg. That usually doesn't work. Mm-hmm. So it makes it very difficult. Young people, when do you start saving? Now. Now is the time to save. People are shocked when I tell them, if you were 20 years old and you put $2,000 a year into a Roth IRA account, why Roth goes tax-free? Take it out tax-free. Can only take your money out up to age 59 and a half, but after 59 and a half, those are all yours tax-free. If you could make 8% putting in $2,000 a year, starting at age 20. When you're 65, that account would be worth in excess of $834,000. If you waited until you were 30 to start, that's just 10 years and $20,000 less, you would only have $372,000 in that account. So the idea around it is start now. If you're young, start now. Put what you can away. Don't wait to say I can save the extras. You have to look at it and saving for your retirement now because, like I said, Social Security and your savings, you're responsible for your retirement. Then we get to the people that are currently there, optimizing. Most people say, I'm going to turn on my Social Security at age 62. I'm going to retire and do all these things at 62. Most people don't realize that the gain in a monthly check, if you retire at 62 or you wait till you're 70, it's a 76% increase in the amount of that check. That's a big difference on what you get. So optimizing your Social Security is the most important thing that you can do, because a lot of people say, well, I want to maximize my Social Security. Wait till you're 70 and live a long time. That's the maximum. But if you're married, now we got two of you all involved in this equation. And that's when we have to look at this, and we have to look at your situation, because it wouldn't make any sense to say wait till you're 70, but you don't have the assets after you quit working to live on between that time frame. So Social Security optimization, I think, is very, very, very important, but we can't do it in a vacuum. We need you to come in. We got to look at those other assets that you have and say, would it make sense for you to delay taking your Social Security? Rule of thumb, I like to kind of throw those out. Married couples, the smaller earner of the two, once the lower earner quits working, turn on the Social Security. The higher earner of the two, delay as long as you possibly can, hopefully till age 70, to get that larger benefit, because the survivor benefit will be the larger benefit minus a few things. If it's the smaller number that outlives, there could be a slight deduction to that number, but that's the biggest benefit that's going to carry forward once you or your spouse passes away. So Social Security, if you haven't turned it on yet, give us a call. Let us do a Social Security optimization. Give us a call now. Let us analyze where you're at and optimize your Social Security for you and your spouse.
You know, there's a variety of reasons why some retirement savers don't consider annuities. For instance, they might think that they're just too complicated, which, again, is another reason you need somebody like Steve, a financial advisor. But some also fear that the insurance company that they get the annuity from could just go out of business and they're going to lose all their money. Steve, where do you stand on this?
That one is not very likely to happen. In 2000s, they had a couple annuity companies that struggled. Most annuity companies, if they run into problems, the state takes care of a lot of the stuff, and they've gotten other insurance companies to buy. So in those few cases, clients did not lose money due to owning an annuity. But I know a lot of times when you all out there hear that word annuity, you grow horns. I can feel some of you doing it right now because I just mentioned it. And I get the people, they'll walk into my office and they'll say, Steve, I hate annuities. And I go, I do too. Which one do you not like? And they look at me like a deer in a headlight. What are you talking about? Which kind? There are basically four kinds. One, single premium immediate annuity. You gave your money to an insurance company and they're going to pay you a lifetime benefit. And if you prematurely pass, they will take the money. They used to not have 10-year certains or 15-year certains. So there were different things that caused a lot of people problems. Variable annuities. They go up and down in the market. You're going to pay a high fee for a lot of the things in a variable annuity because you're paying somebody to manage the money. Fixed annuities. Fixed annuities, they pay you an interest rate for a certain period of time. Sounds a lot like a CD. CDs are guaranteed by the government. Annuities are guaranteed by the insurance, the claims paying ability of the insurance company that you're with. Fixed indexed annuities cannot go down due to market volatility. A lot of people believe they're the end all be all. Too much of anything is not good for you. So if you have an annuity and you're not sure exactly how it's going to work, give us a call. Let's do that annuity x-ray. If you want to know how to protect your assets without buying an annuity, give us a call. We'll do the annuity if that's what you like. And there's other ways to protect your assets if you don't use annuity. Give us a call now. Ask for that annuity x-ray.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.